We need your support. Click the like buttons below. Now onto the video. Welcome to readtheticker.com. Today we're going to talk about the power of simple moving averages in relationship to cycles. Now I'm just going to show you some notes before we go to the chart. On the chart I'm going to show a dominant weekly cycle for Apple Inc. of 148 periods. We found this cycle number or cycle period using our cycle finder spectrum, which applies the Bartel's formula to run through the time series data, that would be Apple price, and to find which cycle periods fit the data best over a data sample. Now we take the dominant cycle, divide it by 2 to find our simple moving average. We'll make it 74. And on that simple moving average we've added some bands above and below the simple moving average. These bands are placed on the chart by how well price has performed below the simple moving average. Just it's based on fit, because you're looking at a chart to see how well it performs on the demand side and on the supply side. So when it goes up, how far does it move away from the moving average, and when it goes down, how far does it go down? So that's a measure of overbought and oversold based on the action of the price. We'll apply a fixed cycle wall cycle at 74, which is the same period as simple moving average. Once again, the 74 period came from dividing the dominant cycle of 148 by 2. And when you do your study on cycles, you take the dominant cycle and you find even multiples of it. Divide it by 2, divide it by 3, divide it by 4, what have you. Multiply it by 2 and see how they fit on the chart. Then you just review the chart for tops and bottoms to see how well it fits with the cycle and how useful it is. That's all there is to it. Okay, let's go on to the example. Here we have our Apple chart. This is weekly, and this is the log chart, so you can see the bumps and bruises of the price action. And here's our cycle chart in chart cycle spectrum. We have a much larger pop-out page for our cycle spectrum here, and I've got 4 scans: daily, calendar, weekly, and monthly. You scroll down to the weekly. Here is the weekly. Here we go. Here is the weekly. And the reason why I got 148, it's not the best Bartel score like 45 is, and because it's actually got the best win-loss points ratio. So there's multiple statistics you can use. I mean, Bartel's value is very important, but you can take into account the movement of the price. So I also like to look at how good the win-loss point ratio is there. So that's why 148 looks pretty good there. I actually should have put 149, but you know, it's who's splitting hairs. Yeah, so that's why I found it quite attractive. And there's another one here at 168, but we're using 148 for the example today. And it's got the highest average, 148, 149. Look at that, highest average win points. So this is where the blue line is, the blue show it is. It's got very low Bartels, pretty good amplitude, and as you can see there, the pretty high what is that, percentage? Just the percentage. The green line up there is the win-loss points ratio. Okay, so that's just a quick highlight of that, and this spectrum here can be drawn in the cycle chart so you can monitor it. Now the point of monitoring your cycle spectrum is because when new data comes in, that's new data that comes in over here, like in the months ahead, weeks ahead, you want to make sure that this cycle you have chosen still maintains high scoring, or sorry, actually say low scoring Bartels, because low scoring Bartels is good, high scoring Bartels is bad. So as new data comes in, you want to make sure that the new price data coming in is still proving that the cycle is still dominant, because cycles can go in and out of dominance relative to how well the future price action behaves. Okay, so I'll just make that a bit bigger. So what we have here in the Apple data, we have a pretty powerful cycle here. We've got a bottom here, a low there in the cycle. We've got a high here, high, low, low. I'll just draw them in, I suppose. Where are we? Yeah. Low, high. This is what they call an inversion. The cycle was so strong, the price action was so strong, it kept on going through So there wasn't really a bottom until about there. See how the price action doesn't really go down? That's a powerful inversion. Cycle top, cycle low, cycle top, cycle low, cycle top. Now this cycle action here is adaptive to price action. So when you see high and low swings like this, that means the price action is starting to mirror the cycle much more closely. So the price action is starting to mirror a sine wave. Here the price action, you can see the highs and lows, but the cycle is a lot lower. That means the price action is not mirroring the cycle, the sine wave as much. Okay, but it is still showing the highs and lows. This is a very powerful impulse wave, and as you can see the ups and downs. Now, like I said before, we had 148. You can see 148 by my cursor here. The moving average is, I've chosen a weekly one because it's weekly data, which is 74. And there's I've got two moving averages in here. That's because I wanted to have double bands. I'm just drawing one on top of the other. Now the bands are chosen. This is a 20% pullback that works, and here's a 40% pullback. So those are the pullbacks below this red line. Okay, you take the 74 moving average, divide, subtract 20%, subtract 40%. Take the red moving line, add on 100%, and then add on 50%. So that's the overbought and oversold. Now, from our previous videos, you can see when the price action goes up to the upper band, that's good demand, extremely strong demand over here. Yeah, good demand, but as you can see here, the demand isn't so strong. The pushing up of price action to the 50%, 50% above the 174 EMA is not as strong. So you can see that there's weakness coming in here. Demand is not as strong as here, and definitely not here, because it's like when way above. See, strong demand, less strong demand. So this is incredible weakness in the GFC. Weakness here, 20% below, 20% below. So that's it. On the Apple thing, we have a very bit of a warning sign, because we have an important cycle peak, which have given us warnings in the past. You compare cycle peaks when you're comparing cycle peaks. You don't look at bottoms, and you go, well, at the moment I've got winner, 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 loser here. So that's, that's a winner, winner, loser, winner. So that's 3 out of 4 winners, and I would suggest be very, very careful about what price action Apple is going to be for the next 6 months. Is this price action here, where it's a cycle peak, the same as this price action here, which is a cycle peak? Meaning it'll price action will be too strong, and it will continue on and bust the cycle or make an inversion. That's a question you have to ask going forward. So we watch price action, and we use our Wyckoff logic to determine whether it's a distribution or a reaccumulation. Okay. Alright, so as I said before, excuse me, simple moving averages are best to use with your cycle studies, because they're simple, no doubt, but they can show overbought and oversold. They show if the simple moving average help to show whether the simple moving average is a dominant simple moving average. For example, look how well the simple moving average hits the major pivots on the chart. In the previous simple power simple moving average videos, I said put a simple average on the chart and try to find where the pivots are. And if the simple moving average is a decision zone around that pivot, then it's then it could be a dominant cycle. And as you're shown here, if it's the goose and the gander, isn't it? The dominant cycle, which is 148, divide that by 2, you get 74. And 74, which is it's nearly 75. Simple moving average is pretty dominant throughout the price action, where major price action has been decided upon it when it consolidates around it, or support and resistance levels. So the dominant cycle and master simple moving average is the term I've used, are related. So take that into account. So if you find a master simple average on a chart and it shows where it's strong support and resistance, and it might be 50, it might be 100, it might be 300, multiply it by 2, and that could be the dominant cycle. Okay? So what we're going to do is we're going to show a sub-cycle using the wall WALL cycle drawing tool. I'm just going to update it. Right, just refresh. Okay, because it's a log chart, these cycles are extended more into the chart. So we want to look now with this wall cycle is half the dominant cycle. Like I said before, the dominant cycle is 148, and this is 74. So what we can is we say, like, okay, here's a top here, bottom there, minor top there, subtop, major top there, bottom there, minor top there, but it was an inversion that continued on, and we got a situation here where it slowed down, and now we get the question: is this a reaccumulation or distribution? So we're watching the price action very carefully, and I suggest if it breaks that red line, which is 151, or gets below 150, we're going to have a situation like this rather than a situation like that. So if you're investing your mortgage money to buy Apple for the next year or two, you might find your returns may not be so good. It'd be advantageous to see price around 118. Obviously, if it gets quite serious, the price will be around 90. Now, based on previous corrections, 118. At the moment, I would say 118, 120. See how we go. As where other corrections have been. But if there is any major crisis, price will go to $90 or $91. Now, obviously, if it goes beyond that, then there's something really serious going on. But we're using the bands, and the simple moving average is to allow price action from before to judge price action in the future. So as a retail investor, we want to find corrections of 20, 30, 40%. We want to make sure those corrections are well within the behavior of the stock. We want to see Wyckoff reaccumulation. When we want to see price action supporting our view, we want to see volume coming in. And the cycles help warn us when there is a turn on. An accumulation, a distribution, or a reaccumulation or a redistribution. And the simple moving average with the dominant cycle, as we've shown here, are related. So here we had a 74 period moving average that shows that it's a master cycle because of its closest and its marriage to the pivots on the chart. See a pivot there, it's a pivot there. Where are we? Pivots down here, pivot, breakthrough here, pivot, breakthrough here. Also happens to be related to the dominant cycle, which is 74 times 2. Whether you find the dominant cycle from taking the simple moving average, and that's a master, or a major simple moving average, and multiplying it by 2 to find the dominant cycle, or taking the dominant cycle and dividing it by 2 to find this master cycle. They're both related, and it's very healthy to find that on a chart to show the underlying theme of everything we want to do as a retail trade and the Wyckoff logic is to show that the composite man is involved in price action and is showing the way either up or down, and that allows us to see their composite man's footprints through price and volume action, so we can piggyback on the road. Because I haven't got $100 million. I'm sure these folks out there with the large accounts, they're moving the market, and all we are as retail traders is trying to surf the waves they create. So simple moving average. This is part 4, end of the series. Thanks very much for watching.